So thank you guys so much for being here. I'm really excited to have PNC Bank. They're new to SCORE. They're not new to the area, but they're new working with us, and we are really excited about this partnership moving forward. So they came to us and said, "Hey, we'd like to do an affordable home ownership program," and they brought in an amazing woman from Freddie Mac. Her name is Nora, and then we have Housing Trust, which has been in the area for a really long time. We got Hong is going to be with us to talk about their affordable home ownership program for first-time home buyers. Just a few things. We are recording this, so you'll get the recording afterwards and you'll get the slides afterwards. If you have any questions, you can go ahead and raise your hand. Just one housekeeping thing because it's new to us. Some of you, I hope, saw the sign in the middle of the driveway. If you parked on the other side of that sign, you can either move your car or you can potentially get it towed. Your choice. We have a new tenant and a new building owner behind us that is not parking friendly, so we apologize for that. So if you did park on the other side of that sign, I just ask that you move your car. You can, but there's a sign that's almost directly as I'm pointing here. So if you parked anywhere that way, on the other side of that sign, that is a potential issue. That's fine. Yep. Or if you parked on the other side of the fence, that's fine. If you have a question, we can go out and look at your car. It just, they started putting notes on cars and threatening to tow. So that's why I'm bringing this up. And, you know, we're trying to mitigate that and have discussions, but. Okay, just tell me what you have. I'll come, you can tell me what you got and I'll let you know if you should move it. So okay, I'll take a look. So any questions, again, you guys can ask. I'll be in the room if you have any questions. Otherwise, I'm going to turn it over to Amanda, and she's going to introduce her team and get us started.
Good morning, soon to be afternoon. We want to thank SCORE for having us, and basically PNC saw a need for this, and we put this together hoping to educate and get the word out on some of the different offerings that we do have available to get people into homes. And just to give you a little information about PNC overall, our regional president, Megan Schupmeyer, has shown up today. PNC is new to banking in the Bay Area, but not new to lending or home ownership. And so we're here and we wanted to just kind of let everybody know a little bit more. So Megan.
Thank you. So nice to meet you all. Again, I'm Megan, Regional President for Northern California. So PNC Bank has been around for over 150 years, but like Amanda said, we are newer to this area. A couple of years ago, we acquired the U.S. subsidiary of BBVA, which brought us a branch presence in all the lines of business into Northern California. And with that acquisition, PNC made an $88 billion commitment to uplift the communities. 2 years in, we've deployed 56 billion of that nationwide. And that's going to really uplift communities and provide opportunities for economic empowerment, provide capital, access to capital for small business owners that are low and moderate income, people of color, really make an impact where we can see the most growth and most development in our communities. Another aspect of this is affordable housing and home ownership. So we've deployed billions here in Northern California for home ownership to low to moderate income and majority minority census tracts, and we'll continue to do more. That was just the commitment we made when we bought BBVA, but we're going to continue to grow and expand in Northern California, and PNC's made the commitment to be a coast-to-coast bank. So again, PNC has been around for 150 years. We hope to be around for more than another 150, and we hope to grow our partnerships with all of you here in the room. So thanks for letting me speak for a couple minutes, and then I think we're going to turn it over to Nora.
Well, I'm so excited to be here. The last time I was here, I believe it was 2 years ago. And every time I show up, they're like, gosh, Nora, it's not affordable out here. I love a good challenge, especially because I'm a national affordable lending senior manager at Freddie Mac. And I have to tell you, thank you so much to our clients over at PNC. Do you know how hard it is to get a Freddie Mac person in the room? Please say yes. I have to go and ask permission from mom and dad, called FHFA. Any of you heard of it? And usually, you know, it's our clients that take priority. We do show up anytime our clients call. With that, let me talk a little bit about what me and my colleagues, my team does at Freddie Mac. We're a very specialized team. See, affordable is in our title. We are subject matter experts on pockets of affordability. We know every single census tract. We do a lot of research with our economists and our analysts before we show up somewhere. Another thing that's interesting is we are subject matter expert on buyer demographics. You see, all we do when we're not traveling is study our portfolio. I was heavily involved in 5 major housing initiatives, partnered with so many experts in the industry. And today I bring you 3 of the initiatives that I've been a part of. So with that, let's get, oh, before I forget, Freddie Mac loves me to mention, all of these amazing initiatives have afforded me one of the highest honors in housing, which is the Freddie Mac CEO Award. I'm a recent recipient. I'm actually the first minority, the first woman, and the first person in all of single family to receive this award. So I'm very proud of that. Thank you. All right, with that, let's get cooking with grease. All right, state of the housing market. Well, Freddie Mac, we're very much known for our forecast. We have such an amazing team of economists, and economists within our entire division actually focus and study so many different important forecasts and trends that are happening within the industry. But as you've noticed, not only is Freddie Mac economists not forecasting the entire housing industry, economists are now not out forecasting heavily as we've previously done. Does anyone know why? Well, we have the largest accumulation of wealth. We now have $29 trillion worth of wealth accumulated. You see, every time I show up somewhere, they're like, gosh, Nora, I keep telling my buyers it's a repeat of 2009. Whoa, I'm a subject matter expert at Freddie Mac. I tend to say, tell me about that. Not so. You see, opposite of 2009, we actually had stripped wealth out of our housing industry. This entire scenario was completely backwards. See, we only have we'll say $13 trillion worth of unpaid mortgage debt. And that's a really low, sad number. I'm very sad about that. Wish it was higher. You see, the demand is so large right now for first-time home buyers, and it's only going to get larger. How large is that demand? Well, there's 71.2 million millennials out there. 50 million have not bought a home. Now, we're all on commission in this room. Do you guys agree? Raise your hand if you would like the commission check on 50 million millennials that haven't bought a home. And if you don't raise your hand, you're not going to get it. Raise your hand. Yep. All right, fantastic. So opposite of 2008, guess what? We have low unpaid mortgage debt. We have a ton of equity out in the housing industry. You see, I mentioned every time someone purchased a home previous to 2008, we said, hey, you look like you have a heartbeat. Let's make you an investor. Do you have financial literacy? Absolutely not, but let's make you an investor. And then once you become an investor, you're gonna wait that seasoning period, 6 months to a year, and then we're gonna refinance you. And we're gonna do that over and over and over again. And we saw what that market actually did to our industry. We don't want a repeat of that. And also, we had so much unpaid mortgage debt, and those were all the families that were impacted with these neg-am transactions that fully amortized. So we don't have a repeat of 2008. And by the way, in 2008, we had excess inventory. Real estate agents in the room, raise your hand. I need to take inventory of how many people are here. If you're a realtor, raise your hand. Okay, great. I have some really great strategies I'm gonna share with you today. But also, realtors, do we have inventory today? Oh, no, we don't. And we'll talk about inventory in a quick minute. Give me 3 slides. But did we have inventory in 2009? Please say yes. Oh, yes, we had so much inventory. And we had these amazing builders that had so much excess inventory. And at the last minute, we're panicking, saying, I can't keep this inventory on my portfolio. I've got to get rid of it. And during 2009, most of those builders actually went out of business. They're not with us today. We'll talk about how we're going to talk, how we are solving for lack of inventory today, because I bring you a solution. There's 3 solutions. With that, I have to tell you, it's phenomenal to know that 72% of our entire country accumulated and retained wealth in a downward market. Did that happen in 2009 after the crash? Please say no. No. As a matter of fact, we started losing so much equity that wasn't accumulated in the housing industry. You see everything that represents in that light shade of blue, that mid shade of blue, and that dark shade of blue means that not only was wealth retained in some of these states, wealth was actually accumulated in a downward market with no inventory, high interest rates, and the largest demand of buyers. Now, I have to tell you, California, I travel the country. I'm a national keynote speaker. We only lost 1% of the wealth we accumulated in the last 3 years. Now, friends, I have to tell you, this is by housing standards. So think of this point of view. Every time you ask a home buyer, hey, would you like to buy a home? No, thank you. Oh, no. We'll talk about interest rates in a minute. One of my favorite conversations. And they're like, no, thanks. It's a really bad time to buy. In a downward market, oh, I don't have mine. In a downward market, when you buy a home, not only will you retain wealth, you will accumulate wealth even in a downward market. Why? That demand is not going away. See, you can't push away those 50 million millennials. Say, sorry, we're going to lock you in a closet. You don't get to buy a home because you didn't want to buy a home. No. Plus, I've got my Gen Zers coming down the pike. These Gen Zers have a different buyer persona because that's all we do at Freddie Mac. We study buyer personas, my team and I do. And these Gen Z buyer personas are completely different from millennials. You see, they think millennials did it all wrong. And they're saying, no, I'm not waiting. I'm not waiting till I'm X amount of years. And I'll ask you that in a minute because you're subject matter experts on the buyers. And they're saying, I got to buy a home and I'm going to create housing strategies. You see, housing industry, they are leaving you experts behind. They're creating their own strategies and they're not coming to you and saying, hey, you're the expert. Can you please guide me? No, they're not doing that. They're figuring it out themselves. Talk about how that's impacting. Now, housing appreciation is at a historical high. And I have to tell you, in a downward market, 72% of the country retained wealth. California, we had a huge migration. So there's 2 types of migrations. Realtors, listen up because this is what's impacting your business. 2 types of migration that's impacting you. Inbound, outbound migration. What does that mean? 348,000 household migrations migrated out of California since the onset of COVID. So basically, all up until last night, we had so many Californians say, I can't live here. I can't buy a home. I can't afford to live here. During COVID, they said, wow, I'm a full-time remote employee. No more brick and mortar. I'm going to migrate out. So they did. And they started impacting more Western states than ever before. They started chasing affordability. Now, by historical standards, millennials tend to flock to coastal areas. You see, they would go to California, they would go to Florida, they would go to New York. Why? 2 reasons, universities and then jobs. But then remote and COVID impacted them. So it started impacting housing. And we started seeing so many Californians actually exit our state and leave into Midwest state that by national standards were quite affordable. You see, I practically lived in Montana and Idaho in 2022 when California opened up and they allowed me to travel because it was the most historic increase of housing appreciation in those 2 states. But Texas has been on fire because Californians leave and go to where there's land and affordability. Now, there was an article that actually dropped this morning, Housing Wire, and it stated the average sales price for first-time home buyers in California is, anybody read it? $900,000. Whoa. But see, I'm presenting here in San Jose, California. And you guys have been working with higher sales prices for a very long time. Do you agree? Does this phase us? Please say no. No, because someone sent me the article and said, oh my gosh, aren't you in San Jose today? I'm like, I live in California. This doesn't phase us. We've been working with this type of sales prices for a very long time. But today I'm going to bring you strategies. Second type of migration, realtors, listen up, is an out of urban, out of suburban, and into rural. See, realtors, what's happening is during COVID, these remote employee millennials said, I don't have to go into the office. I can migrate. I'm going to go somewhere rural. I don't want to be landlocked. I don't have to pay these high urban rents. I'm actually going to go and find some MLS listings in some rural locations. Now, I have to tell you, I'm in San Jose, and some people are like, unaffordable, unaffordable, unaffordable. No, you see, every morning that I present, what I do is I go into my portfolio and I look at my portfolio. I open up and I filter down to the city where I'm presenting. And I have to tell you, we just purchased millions and millions of dollars of loans in this location. And it's not in this city. It is in all those pockets of affordability that I'm going to point out to you today. And if you're not working with millennial first-time home buyers and going over to our clients, PNC, and using all the amazing programs that we've given them, then I'm buying those loans from your competitor, and I'd rather buy them from you. Do you guys agree? Yes, because you're listening to my presentation. I agree with you. All right, so an 11.9% uptick of rural purchases, but guess what? It's really impacting California. You see a lot of these tech jobs are migrating downward. See, they're going into areas where they can actually migrate. And most of these tech jobs are saying, let's go full-time remote. See, brick and mortar is still quite expensive, especially in California. So realtors, you're a subject matter expert in this area. My gosh, Nora, I've been farming my 7 zip codes for the last 10, 15 years. Let's take inventory. How many realtors have been in the industry 5 to 10 years? Okay, fantastic. 10 to 15, got some season. Do I only have one realtor in the room? All right, 15 to 20. Oh, I like that. I've got some seasoned folks in here. Great, fantastic. Well, guess what? That's not where they're buying homes. They're not buying homes in rural locations because that $900,000 sales price, it's a hard pill to swallow, especially if you're a first-time home buyer. However, they are migrating out. And I have to tell you, I don't want you to reinvent your business. I don't want you to go out there and say, gosh, Nora, I'm going to have to create a whole new farm area. Of course not. This is Freddie Mac. We are going to bring you a free tool, and we'll present it before the end of the presentation on how you can actually find your own pockets of affordability and start looking at MLS listings in affordable pockets that actually qualify for first-time home buyers. All right, with that, oh, my deck. Where's my guy? Okay. So I can keep talking because I know my next slide. What is the real challenge? So every time I show up, they're like, Nora, hate to tell you this. There's no inventory out here. Well, I have to tell you one additional thing. And if you've ever heard of strategy, see, I'm a strategist for Freddie Mac. I create strategy for the top 14 clients in the country that send us business. I have to mention, if you keep saying there's no business out here, there will be no business for you. However, your competitors are actually selling us loans, and there is inventory. I actually pulled up MLS listings last night, reached out to Dr. Jessica Lautz, behavioral economist over at NAR. We're really great colleagues. We share data constantly. And first thing she told me is there are so many listings in rural pockets of affordability. So guess what? The real issue is not that there's a repeat of 2009. Oh, okay, stop already because you're almost at the end of my presentation. I'll take it from here. Okay, so with that, I have to tell you what the real challenge is the lack of inventory, okay? So how much inventory do we actually need? Realtors, this is where you shine. You guys know inventory. How much inventory do we need overall? Actually, let's talk about units. How many units do we need? Okay, I'll help you. 5 million units built each year for the next 10 years, just to barely catch up with demand. Do you think we're going to have the National Builders Association say, absolutely, you got it, hang on tight, order is in? No, actually they said, no, Nora, can't. No Freddie Mac, no FHA, no VA. You see, we actually did an entire study in 2020, and they said, how much inventory do we really need? Well, remember that demand? How large is that demand? Who paid attention? Anybody? 50 million millennials haven't bought a home. 71.2 million millennials out there, 50 million have not bought a home. That's the largest demand in housing history. Did you guys know that? And if this demand, if we had inventory, you would be inundated with so many millennials dying to buy a home and qualify, and they would purchase it. So inventory truly is the issue. If you're on social media, please do not ever tell first-time home buyers, hey, hang tight, the GSEs are about to release foreclosures. You have a GSE in the room. Do we have foreclosures? Please say no. Oh, good. Glad you said that. See, I just presented on a panel with Black Knight. They actually track foreclosures, modifications, forbearance agreements for the entire housing industry. We're back to pre-COVID levels, 0.2%. And that's a really great thing. See, sustainability, it's in our mission statement because we're under conservatorship. So we've now created more modification agreements, more forbearance programs. You're out of a job? Great, call us. Call all of our institutions we've created to help sustainability. Inventory truly is the issue in the housing industry. And so is interest rates, but not really. And I'll talk about interest rates in a quick minute. What's going on with inventory? Why aren't they building? Well, during COVID, a lot of our friends went out of business, and then the local policymakers started pulling up all these regulations and laws, and it's not affordable to actually build an affordable home. It's not profitable either. Ask any builders, and I travel with builders constantly. I was with builders all last week. They co-present with me, and I have to tell you, there's 3 reasons: lack of lumber, cost of lumber, and manpower. You see there's an opioid crisis within the builder community. So they're losing a ton of manpower. A lot of these contract workers are actually losing their licenses. So I have to tell you, if you have a millennial or a Gen Zer that doesn't want to go to college, please send them to the National Builders Association. They will pay them to get licensed, and then they will hire them. They need manpower. Okay, so I mentioned that's the real issue in housing right now. We are really deficient on inventory. Well, we got together during COVID and at Freddie Mac, and actually we called all of the experts that are really good friends out in the industry, and we said, yikes, guys, we have no industry. No inventory. And they said, we agree. And we said, well, we have to come up with some solutions. We came up with 3. Today I present 1. So let's talk about buyer personas. In this entire housing market, you now need to create niche clienteles. And I have to tell you, you have to be the subject matter expert on this buyer. You see, Freddie Mac, I was part of a 4-year millennial study, and we're about to present our 5th installation of buyer personas. One of my economist colleagues is about to present it next week. And during this millennial study, what we said is, well, we've got all this amazing portfolio and hundreds of millions of dollars of data. Why are we not sharing it with the industry? So we did. This is the most diverse buyer demographic and also age demographic in housing history. You see, there's brand new challenges that this buyer has that we've never had in housing before. And I have a very strong credit. I used to be a credit officer at one of the largest banks. And I have to tell you, my underwriting signature used to actually, was out there with complex situations. But I have to tell you, today's buyer, totally different buyer. Gorgeous FICO scores, gorgeous. And I'll show you what FICO scores are around here, because I don't want anyone telling me, oh, credit, oh, it's a big issue out here. Hang tight, I've got FICO scores for you. These buyers actually come with brand new challenges. You need to know how to close the conversational gap and how to offer solutions. But I have to tell you, see, I'm an expert at Freddie Mac. You are the solution. They just don't know it. So we have to close that conversational gap. So let's take a quick quiz. According to NMLS, what's the average age of an originator in America? Yes. I like that. They're seasoned. No, not so much. That's a seasoned originator. 40 years old, a little bit of a millennial, but no. 35, no. I would like that. That would be great. A lot of these young millennials coming in and helping their millennials buy homes. Yes. 50s, yes. 54. So according to NMLS, our industry average originator is 54. According to the DRE, what's the average age of a realtor, realtor, agent? 56, that's right. Who said that? I like that. Good job, great guess. Yes, 56. So You guys know these buyers. See, I don't originate anymore, and I don't get to see them all the time. I do interview them all the time, though. What's the age of the oldest millennial out there? 29, no. 70. My dad's a millennial. I like that. I'll let him know. He loves that. Someone said 44. It's actually 45. What's the age of the youngest millennial out there? 30. No. No. So you really need to know this buyer persona because you need to know who you're targeting. You really need to be a subject matter expert because they think they're invisible to you, our industry. And they made sure to tell us that during our study. See, these younger millennials are now 25. That 45-year-old is creating household formations. What does that mean? They're getting married. They're having children. No longer is it sustainable to live with mom and dad at home. If we were on the East Coast, I'd say basement. We're in the West Coast. I say garage or ADU. See, they're having average of 3 children. It's not sustainable. So what did they do? Right after COVID, as soon as COVID opened up, they went and started renting in these high urban markets, high urban rents. Yikes, I can't afford a payment, Nora, but I could totally afford a high urban rent. I love to rent. Yeah, see, they love to rent so much, we call them at Freddie Mac historical renters. We'll talk about that in a minute. All right, so with that, the younger millennial is now 25. See, they're fully immersed in the workforce. They are most of our colleagues. I have to tell you, at Freddie Mac, we love interns. And all of a sudden, we see 1 million interns that are very, very young to the industry as part of our colleagues. And guess what? They are out earning. These millennials, older and younger, are out earning every other age demographic at their exact age. What? Yeah, you see, they have more higher learning degrees than ever before. They are the most educated age demographic. I'm so highly impressed by them. So many PhDs, so many masters. Why? Well, during the crisis, most of the older millennials graduated university and came out into a horrible economy, but also a horrible housing economy. And they graduated and said, whoa, 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 no, 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 no. I have a bachelor's degree. I will not be a Walmart greeter. I will not work at Starbucks. So they went back to college and actually got a second degree and a third degree. And they are so highly educated. And that's why their earning power is so strong. You see, if there was inventory, this age demographic would go down in history books as the strongest buyer. What's the issue? Why haven't they bought? Hang on, I'll get to that. Well, during our millennial study, we asked a lot of big questions. And most of those questions are what we called aha moments, where we said, what? What? See, my friends at Freddie Mac, my colleagues, we call each other Freddie Mackers. And I would look at the side of the room as soon as someone answered a question. I would say, what? No wonder they haven't bought a home. Well, guess what? Their older millennials actually mentioned to us, they're very jaded. Early in their age, they were very jaded from the 2009 mortgage crisis. You see, they saw their parents lose their home. They saw their parents sign modification agreements, and they didn't understand them, but neither did the parents. And they saw their parents tell them, don't buy a home. It's a scary world out there. Don't buy a home. You have student loan debt. Don't buy a home. You don't have 20% down. Don't buy a home. You don't have perfect credit. And guess what? They didn't buy homes. For a very long time pre-COVID, they said, I'll live out here and enjoy the experience of life. I don't want to buy a home. And we would say in the housing industry, what? What experience in life? What are you talking about? We didn't understand them. We also have a giant conversational gap between our industry and these first-time homebuyers. Do you guys agree? Please say yes. Oh yeah, see, they don't come to you. They don't say, hey, you look like an expert. I think I want to buy a home. I think I'd like to accumulate wealth. I think I want to close generational wealth gap because I'm now 45. You see, I'm a Gen Zer. My age demographic, we're fantastic. We're my fate. I love studying Gen Z loans and Gen Z history in housing. You see, we had the worst FICO scores. We had no money down. We were the heaviest users of gift letters. By the way, most of the folks on our gift letters turned out to be our husbands and wives. I thought they were family. I thought they were family too. Yeah, every time the loan officer would fill out that gift letter as an underwriter, I was like, I don't think you've known her for 15 years. Anyway, also, did I mention we had more student loan debt than ever before? By the way, horrendous credit over users that never paid their debt. Did I tell you we had tons of student loan debt and we forgot to go graduate and pick up our degrees? Oh yeah, we were phenomenal. And we bought homes at the average age of 26 years old. This buyer demographic came so early to the buying table that we studied that. Phenomenal, isn't it? But these millennials, they're more educated, better FICO scores, out earning every other age demographic. Why haven't they bought a home? Well, I just mentioned. See, Gen Xers, we didn't have boomers and older Gen Xers telling us, don't buy a home, bad choice. Don't buy a home, don't worry about it. Don't buy a home, don't buy a home. And so they did not. But these younger millennials, they have a totally different buyer persona. They're like, oh, older millennials did it all wrong. Oh no, I gotta buy a home. But guess what? It's not affordable right now, right? I just mentioned, especially in California, 900,000 sales price. Now, I have to tell you, these aha moments, 40% of these millennials that were part of this survey actually said, I'll migrate, I'll move, not a problem, sure. Most of them also said, I'll quit my job, I'll go get myself promoted and get another job and become a remote employee. We're like, what? What? This is called a buyer persona. Absolutely. See, this millennial is so smart, but also they pivot quick. Okay, cool. What do I need to do to buy a home? So we explain the home buying process and they're like, oh, I can afford here. Sure, I'll move. Let me call my employer. And we were like, oh, wow, 40%. Never in housing history have we ever heard 40% of millennials or buyers saying, I'll migrate, I'll leave urban, out of suburban and into rural. Sure, not a problem. Is that what everyone else is doing? Cool, let's do it. Whoa, scary. But we said, this is what we have to share with the housing industry. And then when we showed urban rents and compared them to a rural PITI with MI payment, and we said, this is what a mortgage payment looks like in rural. This is what you're paying in your rent now. 82% said, oh, I can make that mortgage payment. Oh, wow, 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 wow. And we said, have you never been pre-qualified? They said, no, absolutely not. No. See, every time you go up to them, their biggest objective, I have student loan debt. No, see, I'm Freddie Mac. I love student loan debt. PNC, I love to buy it. I love to buy the student loan debt that you guys sell us all the time. Oops, I need help again. Someone, my deck just went out. Okay, so anyway, I'll keep going. With that, see, student loan debt is not an objection. And let me actually dispel the myth on all student loan debt. Only 32% of all millennials actually carry student loan debt. I'm going to say that one more time. Only 32% of all millennials actually carry student loan debt. Only 32%. Let's quantify that even further. Of the student loan debt that they only carry about $39,000 of student loan debt. Only. But they say, I'm drowning in debt. I'm drowning. And we're like, why? Why are they saying that? So we went in, started looking at their credit profile. Yeah, they are drowning because that's their only debt. See, they are not heavy credit card users. See, they have utilized credit quite well. I'll show you FICO scores in a minute. So with that, after our study, oh, by the way, let's quantify student loan debt even further. How much does that impact the student loan debt payment monthly? About $360 a month. Can that make or break a deal? Absolutely, but not always. And the not always is the portfolio loans that I study. I see these amazing loan officers that know how to structure loans very strongly, get gift letters, pay down debt to qualify, and see a withdrawal of 401k for the financing of an owner-occupied home. You see these millennials, they don't know. They don't know that they can do that. By the way, most millennials, one great thing that boomer and Gen X parents did is tell millennials, hey, gotta invest your money. Don't buy a home, but open up a 401k. And they did. If you ask millennials, do you have a 401k? Because usually they say, I have no money. I have no money for down payment. And I say, but do you have a 401k? Oh, yes. I've been contributing to a 401k for a very long time. And that's a question our industry is not asking them because they don't know. They don't know that you could do a one-time hardship withdrawal. So when we said, how many of you are willing to buy a home now after the entire study? We went over the entire buyer process. This was a very long time. 54% said, oh my gosh, I gotta buy a home and I gotta buy a home now. And we said, I'm sorry, I gotta buy a home, I gotta buy a home. I think I'll wait 2 years. And we said, don't buy a home. No, don't waste your time. No, no. And they looked at us and said, huh? No, see, 2 years too late. Did I not just educate you guys? Housing appreciation is not stopping for this age demographic. You see, housing appreciation is actually going larger. I just showed you a map in a downward market, high interest rates, no inventory, largest demand. 72% of the countries continue to appreciate wealth. See, housing appreciation is going to price them out. If they qualify today, they buy today. Let's talk about interest rates. Oh, my favorite conversation. You see, we've been tracking interest rates for the entire housing industry since we were enacted by Congress. You can ask me a date. I studied 50-year portfolio on interest rates. So during our millennial study, we asked them, how do you invest your money? Well, they were over the European experience. They didn't like the European experience. And then COVID really crushed their dreams. So basically they're like, crypto and Bitcoin, Nora. Oh, no. What? You guys, I'm a finance major. I'm like, why? Oh, everybody invest. And I said, how's that working out for you? And they're like, bad month. No, bad day. You see, that's a volatile market. No, 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 no. But hold on a second. Let me bring you back. 2022, January to December. If you bought a home in California, you appreciated and accumulated wealth at 32%. Your ROI from January, 1 year, January to December 2022, when the interest rates were still okay, you accumulated wealth at 22%. In a downward market, you retain 31% and you only lost 1% in California. That is an ROI I'm willing to, and I'm a finance major. I'm at Purdue right now as a full-time student. I'm willing to risk that. That sounds beautiful. Absolutely. But can I tell you, it's only going to grow larger. You see, the demand does not go away. And I have to tell you, every time you're like, oh, Nora, it's not affordable out here. Okay, if you have that mindset, I don't know how to help you, but today, hopefully we're bringing some awesome data, some awesome folks, and PNC is here with phenomenal products that I'll talk about in a minute. They will talk about them too. You have to really change your mindset. See, I come in from a national view. I go national, then I go MSA, then I go zip code, then I go city, then I go actual address. And I pulled up today's address and I was able to find pockets of affordability. See, your mindset is, I've only been working with these folks and this is my territory and that's why there's no business. And I agree with you because they're buying in rural locations. All right, 54% said, I'll buy in the next 2 years. We said 2 years too late. You qualify this year, you have to buy this year. Next year, you'll need a non-occupant co-signer, a second signer, a third signer, a fourth signer. Sounds familiar. I'm a Latina. That sounds like all my family members. There was 5 of us on a loan. See, that's called a buyer strategy. See, Latinos actually impacted housing because we changed the 1003 application in 2011. You see, we needed more spaces to put more buyers on a transaction to qualify. That sounds like a strategy, Nora. Oh, it certainly is. And guess what? These Gen Zers I mentioned at the beginning of my presentation are creating strategies. That's what their strategy looks like. Mom and dad are going to help with the down payment. Brother, sister, everyone who graduates college are going to get together and they're going to buy one home. They're going to refinance in historical housing appreciation. Within 1 year, they're going to turn around and buy that second home for the second child, third home for the third child. You see, there's so much wealth accumulation and it's actually being held by boomers and Gen Xers and older millennials that actually bought homes. See, we are sitting on that wealth and we are willing to refinance or pull it out of our 401ks to help our children buy homes. And that's called a strategy. Did they come to you and ask you for permission on that strategy? Please say no. They did not. They didn't even come to us. We're GSEs. We create loan programs. See, they're doing it all by themselves, but did they also reach out to you and ask you, should they migrate? Say no. No, they left our industry behind and our realtors are really, really behind. And I always tell NAR, we need to get more information to our realtor partners. We have to create strategies so that they can pivot. I have to tell you, our industry right now is how fast can you pivot? And if you don't like change, please leave our industry. We had changes to our guidelines at Freddie Mac. Every time I present, I usually have to, someone reaches out to me. As a matter of fact, I was sitting over in the corner and one of our speechwriters reached out to me and said, guidelines just changed. I know you're presenting. Make sure you read them. Here's your talking points. Whoa, 5 minutes before I present. Good, let me memorize them. So I have to tell you, you really have to learn how to pivot and you have to really think, I have to create a strategy for my business. All right, let's get cooking with grease. During our study, what we started understanding is most of these millennials kept raising their hands saying, I need 20% to buy a home. We said, no, we're Freddie Mac, 3% conventional. By the way, I love FHA. I love FHA. I love Marsha Fudge. She's no longer going to be with FHA, but in the words of Marsha Fudge, 2 reasons to send your transactions or first-time home buyers to FHA. High debt to income ratio, low FICO score. See, don't throw all first-time home buyers into FHA because that puts risk in government, okay? So if they qualify for conventional conforming, please help them, put them into conventional conforming. Why? Well, they have to accumulate wealth. Upfront mortgage insurance premium and MI for the life of the loan doesn't help them, but if they qualify only for FHA, we don't care who you use. Get them into a home. That's all that I'm here for. With that, they said, if I qualify for 5 programs, can you please talk to me about them? They basically said that they believe any time they talk to an industry professional, all they ever hear is, you're a first-time homebuyer, FHA, and they haven't even pulled their credit. So if I have to tell you one more strategy is to be a subject matter expert, even agents, you now need to know loan programs, what's out there, what's happening, what is PNC launching, what terms of business are we giving our PNC senior leaders? So you really have to know what type of programs are out there and have a really great relationship with your loan officer. Now, here's the interesting biggest conclusion. These millennials, so much student loan debt, so many higher learning degrees, so much earning power, yet they are financially illiterate. They have no clue. They don't know anything about housing, but they don't know anything about the mortgage process, all the way from inception of wanting to buy a home to post-close. Guess what? They also don't know that you are the expert as the realtor, and they also don't know that my PNC loan officers are the subject matter experts. You see, realtors, I love you at Freddie Mac. We love you. We know you are a very important part of the housing ecosystem. However, when they're ready to buy a home, they talk to mom and dad. They tell mom and dad, hey, I think I'm ready to buy a home. And mom and dad say, oh, so bad right now. And then they get through the so bad conversation, and then they look at MLS listings and they love that porch. So pretty. I like that porch. I think I'll buy a home. Do they want to accumulate wealth? Who knows? The porch is what sold them. But mom and dad just gave them really old, stale advice. You see, mom and dad haven't bought a home due to inventory in the last 10 to 15 years. I'm in that scenario. And grandma and grandpa haven't bought a home in 15 to 20 years. And that's why they're sitting on so much equity. Are they the experts? And are they in this room listening to Freddie Mac's and PNC's latest programs? Please say no. I agree with you. I agree with you. So when it comes to financial literacy, my PNC loan officers are actually creating first-time home buyer literacy events, and they're hosting home buyer events as agents. It's called a strategy, by the way. Reach out to them. Hey, can we do a home buyer event? Hashtag millennials. By the way, I forgot to mention, single women are the second largest buyer demographic that nobody is marketing to. Why are you guys not marketing to them? I was part of that initiative as well. It was a 3-year study, and these single women are out buying men twice as fast. They have more student loan debt out there, but they are accomplishing every single goal that they set for themselves. More higher learning degrees, great FICO scores. This is not an entry-level buyer. This is a buyer that comes with assets. All right, with that, I love when I show up and they're like, Nora, sounds fantastic. There's no millennials out here. Cut it out, San Jose. You have so much migration of millennials, and actually you have a lot of migration of millennials coming from the Midwest. You see, they're graduating universities and they're coming here for tech jobs. Oh, I love tech. I was in Wyoming 2 weeks ago. Yeah, 2 weeks ago. And everyone from Wyoming said they're leaving to California for tech jobs. And I said, I know. I've been studying this for such a long time. You have so many opportunities with younger and older millennials. And I have to tell you, next week, I'm in Albuquerque, San Antonio, and Dallas in 3 days. And I don't get to tell them this same conversation. And their FICO scores don't look as gorgeous as yours do. With that, most of the time they're like, oh, minorities, none out here, cut it out. My Uber driver, thank goodness I speak Spanish, actually got lost. And guess what? He's a Latino. And I started asking questions in Espanol. And I said, hey, you're here. Tell me all about, oh, yes. I used to live, I was born here in America. I went back to our home country to study university. I forgot English, but I'm back and I'm back. I actually just got a job and I'm very excited. And I drive Uber as a part-time gig. And I said, sir, that's called gig economy. And gig economy is not leaving our industry. It's now happening. And we have embraced it at Freddie Mac. You have more Latinos out here. And I have to tell you, at Freddie Mac, has anybody ever heard of NAREP? National Association of Hispanic Real Estate Professionals, ran by Gary Acosta? Okay, good. Have you guys ever heard of the State of Hispanic Homeownership report that he puts out every year? And it's basically talking about how Latinos are doing out in homeownership. Well, we actually are the co-authors of that entire report. What you've seen here is mostly part of that report. Last year, we forecasted, we said, 20 years, I think we'll be the majority of first-time home buyers in 20 years. Well, I was in DC in February presenting this report with Jaya Day, our economist at Freddie Mac, that actually helped create the report, the entire team that got this presentation together for you. And guess what? We achieved that goal in 1 year. We're at 49.99% of first-time home buyers. Latino is a huge population. I have to tell you, quite loyal. During our millennial survey, we asked these millennials, hey, if I give you my best real estate agent, if I give you my best loan officer, how many referrals will you give them? By the way, they didn't know you're on a referral basis. They had no clue. And they sent in all the surveys. We compiled all the information. 7, who can use 7 ready buyers? Raise your hand or you don't get it. Oh yeah, raise your hand, yeah. Well, guess what? These financial literacy events, this home buyer education that my PNC loan officers are doing actually makes them a trusted advisor. And that's all they're looking for. Who's the trusted advisor that I can go to? Now, real estate agents, I mentioned you guys are important. See, they know how to read my credit report. They know my guidelines. They know how to structure a transaction. They are our trusted advisors. So financial literacy is the way you can actually create a niche pocket of first-time home buyers. We are tracking 3 individuals that are doing financial literacy event, and one of them has increased their business over 300% from January to June. 300%. Completely revamped their business. So with that, most of the time I show up and they're like, oh, everybody's bought a home out here. No, you see that second graph? That represents all buyers. And you have almost the same equivalent of renters that you do buyers out here. By the way, I break down the data very granular. So when you have time, you're going to get a copy of this deck. Who wants a copy of my data? You're going to have to go see my PNC loan officers because I'm only going to send it to them because I need you to network. It's called a strategy, friends. I said I'm a strategist. Do you guys, yes, go with me. And then I show up and they're like, Nora, FICO scores are so horrible out here. Okay, well, we have done such a great job by national standards. You see the US now has an average FICO score of 681. Rod, can I buy a loan from you at 681 mid-FICO? Please say yes. Thank you. All day, every day, except weekends, because we're closed. California, by national standards, phenomenal, 698. All day, every day, except weekends. That's a good, gorgeous FICO score. I'll buy it. Now, San Jose, all of the bigger MSAs out here. By the way, most times they're like, oh, I don't see my MSA out here. Great. We only pick, and I only do data on the hottest MSAs and pockets of affordability. It's called a strategy. So with that, 742 FICO score. Do I get to say that in Albuquerque? Please say no. No, you see their FICO score is 681. Do I get to say that in San Antonio? Please say no. 672. You see, this FICO score is one of the strongest that I've seen in a while. And I called my colleague that actually manages this account. Her name's Mia. She's not able to be here, so they sent me, sorry guys, they sent me instead. But I told her, oh my gosh, look at this FICO score. And she said, what? And I said, all day, every day. With student loan debt, yes. With less than 20% down, yes. With less than perfect credit, yes. All day, every day at Freddie Mac. So I have to tell you, please, please utilize data and analytics to be able to create a strategy. No more forecasting. See, I've been in the industry for 25 years. I started as a subprime underwriter, manually underwriting transactions, selling 13 to 19% interest rates with a gorgeous 3-year prepay that cost $10,000. If someone tells me if someone tells me interest rates are high right now, I tend to say, okay, sounds good to you. So FICO scores in these millennials. So during our study, we asked rates were 7.5. We basically said, hey, what do you think of interest rates right now? And they were like, ugh, horrible, horrible, horrible. And we're like, wow, they're a little snarky. I like that about them, though. I really do. If you're a millennial, raise your hand because I've been identifying you in the room as I've been walking. Yep, 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 yep. Okay, so with that, they said, I don't like 7.5. Okay, great. I said, why did you buy January 2022 then? And they looked at us and they're like, huh? Yeah. You're so highly educated. You have so many degrees. You know the market so well. You don't like 7.5. Why didn't you buy January 2022? What happened January 2022? See, I don't pull interest rates anymore. I track them. What happened? That's right. Lowest interest rate in housing history, 2.35 conventional conforming 30-year fix. See, that's the lowest interest rate ever in housing history. And according to the feds, which have been very transparent with you, please listen to what they have to say. They basically said, unless another world economy comes with another global pandemic, we will never get that interest rate back. And we're still seeing the offset of that interest rate. So I have to tell you, they don't like 7.5. They also don't like 2.35. Don't like it at all. Ugh, 2.35. But they love 100%. Oh, they love 100%. You see, every time that landlord sets that rent, it's at 100%. And they say, yes, not just once a year, twice a year. And they say, yes, I like that so much. Oh my gosh, I love 100. Don't give me 2.35. Don't give me 7.5. That's yucky. I like 100%. And I'm now called a historical renter. So every time you ask someone, hey, would you like to buy a home? And they're like, oh, interest rates. You better call them over and give them a little lesson on interest rates. See, they have no financial literacy, but they also don't know how to follow the market. They don't understand the yield spread premiums. They don't understand the market at all. One more thing that we asked is, how do you like that tax write-off at the end of the year at 7.5% interest rate as a renter? And they said, what are you talking about? And we said, yeah, we know. Yeah, we know. See, have you ever done the numbers on that 7.5% tax write-off at the end of the year? And have you compared it to 3% down? Because in most rural markets, they equate. So they may get their money back, or they may get close to their money back, but you have to do the numbers. And I have to tell you, industry, for a long time, we kept saying words like low-hanging fruit. No, see, that's not today's buyer. You have to go out and you have to be that subject matter expert to be able to attract that buyer, because he needs to know, I've been in the industry 25 years. Yeah, they don't care about that. They want to know, how do you know me? Do you know how to help me? Can you help me? Can you identify me? Do you know how old I am? Do you know what my FICO scores look like? Do you know what my buyer persona looks like? What does that mean for you? Is that there are many qualified buyers out here. And according to our State of Hispanic Homeownership Report, there are 92,000 millennial buyers in your MSA that are Latinos that have credit where they can actually qualify for a mortgage. Now, I have to tell you, 92,000 sounds great to me. So don't come up to me after the presentation and say, oh, this is fantastic. Yeah, we won't have any buyers out here. I've just created an entire strategy for you. I just took you through a storyline of a strategy. Now, let's talk about addressing the real issues, which I mentioned are inventory. Realtors, this is your time to shine because you are the subject matter experts. You know the home, you know the area. I know everything about that house. What's the average age of a home in America? What? What? I thought you'd be screaming it out. Realtors. No. 40 years, no. 50, who said that? Good job. Are you a realtor? Oh, darn it. See, she's a PNC loan officer, and she gets to see page 2 of the appraisal down at the right left-hand side where it says average age of the home. I like that. Good job. All right, with that, I have to tell you, age of a home in America is 50 years old. California, we have not flipped enough homes for us to say we're any younger. Do you know what the electrical and plumbing looks on that home? Oh, I do, because I've traveled the entire country with builders, and all we do is go inside homes and look at aging housing stock. So there's a wide gap between affordable housing and buyers. What's the demand? How many millennials are out there that haven't bought a home? You better know this. 50 million, I like that. That's it, you're getting a ton of them. All right, by the way, there's a new risk in our housing industry that we are now starting to talk about. It's actually 2 of my calls when I'm not traveling, and that's natural disasters. You see, I was just in Oklahoma, and then the tornadoes hit. And then I was in Chicago at the O'Hare Airport waiting to board a flight when there was actually another tornado that actually hit, and it's too early. And by the way, that airport is not in Tornado Valley over in Chicago. See, new natural disasters are happening, but guess what? We are used to it, California. Are there fires? Say yes. Okay, good. By the way, I write a report and I send it to my senior leaders when I'm done, and I usually like to fluff it up and say, oh my gosh, they said yes, yes, every time I asked a question. So I make sure you get a little loud. All right, with that, natural disasters is really an issue. So you need to be very, very well-versed to be able to answer that question, because these millennials, they are very concerned about climate change. That's very important to them, and you need to know. That's called a buyer persona. What's important to them? What's the WIFM? So if I buy a home, will my house burn down? And if it does, how do I get help? How do you get help? So make sure you know. Get with your PNC loan officer. Now, one of the solutions to lack of inventory, I've been working on this project for 2 years, is ADUs. Oh my gosh, I'm so fascinated. By the way, I would like to say, because I'm a Latina, before I got to Freddie Mac, I'm a subject matter expert on ADUs. You see, my cousin worked in construction, and we used to turn garages into homes. Were they permitted? Please say no. No. And they had a kitchen, a kitchenette, our underwriters used to call them, or I used to call them, and a bathroom. Were they permitted? Absolutely not. We just needed a bag of cement, and we would turn it into a gorgeous home. Well, guess what? We love ADUs at Freddie Mac. And I have to tell you, we have one of the most favorable states for ADUs. Realtors, this needs to be your new product. And I have to tell you, this really is a solution for California. I've worked on this entire initiative for 2 years. I know what ADU housing laws are for all 50 states, including Puerto Rico. Guess what? More minorities love and used to finance ADUs, but guess who's buying ADUs now? Millennials, because they need a she shed for their remote work. You see the housing inventory, realtors keep me accurate. Most of the inventory actually has 3 bedrooms, 2 baths. That's average type of MLS, but sometimes they have more kids, and sometimes they're remote employees. And sometimes, like in my case, my husband and I are both in finance, and we're both remote employees. And I can't stand to hear his conversations when he's screaming on the phone. And I'm like, I gotta go somewhere. So guess what? We built an ADU. I also have to tell you, most of these Gen Z children are not leaving the nest quite early because they're saving for their down payment. And ADU is really, really a fantastic way. And I was actually talking to someone who has a ADU, has their college-bound student in their ADU. And I also have to tell you, multi-generational households, Latinos, AAPI community, the African-American Black community, and Latinos, we take grandparents with us. I even have aunt and uncle. I have an older aunt and uncle, had no children. They're with us too. We carry multi-generations with us. And these ADUs are a game changer. Real estate agents, you need to get with my PNC loan officers to better understand the program. However, at Freddie Mac, I just mentioned, we got to pivot fast with the industry. Well, guess what? We pivot so fast, we just changed guidelines. Do you know how hard it is? I like that. That's the same way I felt about changing guidelines. Do you know how hard it is to change guidelines at Freddie Mac? Please say you do. Because I work on that. I just won a CEO award for that, especially when it came to ADUs. Well, guess what? What is an ADU? So I have to tell you, it is a converted, we say basement, this is an East Coast also friendly presentation. It's a converted garage, and it's an addition. Can it be larger than my subject matter expert? Please say no. No, it cannot, Nora. And I have to tell you, it needs to have an additional living area, okay? So it needs to have its own entrance, okay? It has to have a kitchen, has to have a bathroom. Does it need permits? No, come on. Why am I here? See, Rod, I did need to present this product. All right, no, it does not. We will buy it if it has no permits, if it's existing. But if you're gonna build it, yes, it does need permits. No, if it's an existing ADU unit and it did not have existing permits when it was built, as long as it's health and safety, you guys, I can't have an exposed gas pipe that was not capped. No, don't send me that. I need sustainable homeownership. I just mentioned we changed our guidelines. So not only will we finance one ADU property on a subject location, we'll do 1, 2, and 3. We need to create inventory. Do you guys agree? Absolutely, I agree with that too. And California is the most ADU-friendly state, state and city and county. With that, guess what? I can't wait to qualify these millennials who have never been landlords on an ADU and make them a landlord. See, we need to help them qualify and use 30% of my net rents to be able to help them qualify. But Nora, they've never been landlords. Good. Do we have any MI companies in here? Where? No? Darn, good opportunity. I usually like to give them a shout out because they do free landlord presentation. See, we will get them educated. We will make them financially literate. And this is a fantastic product to be able to qualify them into inventory. Now, I have to tell you, appraisal requirements, that's usually a concern. Well, please don't let it be, because we also changed our appraisal requirements. We just need an ADU within a 6-mile radius, and we will allow for adjustments. Why is the market great for ADUs? Well, I mentioned multi-generational, I mentioned millennials, I mentioned minorities, I mentioned college-bound students that can't find housing. You see, everybody needs housing right now. I will close us out with two great products, and one of them is Home Possible. And I have to thank PNC because they do a phenomenal job. Now, mostly I show up here, San Jose or San Francisco or Sacramento, and they're like, yeah, Nora, we can't use this product. You better not say that to me. Go say that to someone else, but not me, because remember, I'm an affordable expert. So we took our pockets of affordability using this address, and I found 11 zip codes that qualify for this program. Now, you will hear a huge announcement that I can't talk about right now because I'm not approved. Nobody is actually. Hang tight. I think you would be quite happy with something coming out next week. Hang tight, don't ask me. All right, you didn't hear that from me. Guess what? A lot of these Latino millennials co-signed on homes for their parents. Remember I mentioned me, grandma, grandpa, cousin, everybody qualified for a home. So most times we don't have opportunity for them to be a first-time home buyer. But this product, we don't care. You don't have to be a first-time home buyer. We allow repeat buyers. You see, we want to get everyone into housing. 3% down, and the beauty of this product is 0.25% MI. Give them a higher sales price or a lower monthly mortgage payment. With that, I mentioned, I don't want you to revamp your entire business. You don't have to. You have to actually find, let me use my, I don't have my own clicker. This is my Home Possible affordable tool. It's a free tool. Now I called my Freddie Macers that track this tool. I said, hey, are my loan officers using it? They said, no. Oh, good. That made me happy. And then I said, hey, is my real estate agents using it? And they said, no. And that made me even happier. And then I said, well, who's using it? Because I see all the metrics on this. First-time home buyers. They didn't come to you and ask you for permission to find pockets of affordability, correct? No. See, they actually left you and they went and found the tool themselves. And what they do, agents, is every single MLS listing that you send them, they drop it into that gorgeous little box search engine up at the top. And they say, yes, take me here. No, don't take me there. See, I'm pre-qualified for the product. Take me where I can afford this amazing program. Don't take me there. Even though I love the home, I won't be able to afford it. So I have to tell you, this is how you find your pockets of affordability. But hold on, because we're not done. Like Oprah says, one for you, everybody, it's free. And I have to tell you, I put a little bullet, free down payment assistance programs that qualify for that particular address. If they are out of funds, I will let you know within 48 hours. I will remove and gray out that website. Loan officers, go in there and start getting certified to do those programs, because we give you the link and we take you directly to our partners. Now, with that, I have to tell you, we never upsell from FHA. Phenomenal product, saved us during the mortgage crisis. But guess what? We are not in a crisis. We have the largest demand of buyers. We have to get them into housing. If they only qualify for FHA, I don't care what product you use, get them into a home. If you can help them accumulate wealth faster, get them into a conventional conforming loan. I would love for it to be Freddie Mac's. We love student loan debt. We love self-employed buyers. Do you guys agree? PNC, do I love self-employed buyers? I like that. See, the redheads down the river, they're called Fannie Mae in Washington, D.C. They don't like when I say that. Is Fannie Mae in here? Oh, they're not. All right. Just kidding. They're actually quite my friends. And they know I say this and they love it. They don't think it's funny, though. All right. For the rest of the country, no geography, no income restrictions. We've got our other 3% traditional first-time home buyer program. Now I have to tell you, PNC is going to do a phenomenal job of presenting amazing programs that we have given them as terms of business. They are one of our priority clients. So I have to tell you, if you want this deck and you want to partner with them, you want to grow a niche clientele, you got to go network with them. Raise your hand, PNC, stand up, actually. Stand up. You need to be identified. Wow. Great job. Clap for them, please. They got you in the room. Remember? Usually when I show up, they're like, gosh, you do exist, Freddie Mac. We're like the M&Ms. We do exist. All right. With that, I'm a Latina and I talk really fast. And you're like, what did she say? Good. I'm glad you say that. I just created a cheat sheet for you that I used to use, something similar. So I called our Marcom team and I'm like, hey, do me a favor, compare both programs so my loan officers and my agents don't get confused. This is a fantastic cheat sheet. Save it to your favorites. With that, I want to help you grow your business. I have to tell you, stop going on social media and saying the market's crashing. Stop going on social media and saying the GSEs are about to release foreclosures, because we're not. They don't exist. I want to give you reputable data. Do you want reputable data every day you can share on your social media handles? Good, I'm glad you said that. You see that link down at the bottom? It's a live link that I just sent my friends, and you get to go in there and sign up for every single topic. Now, I will give you a warning. Careful what you ask for. We are not a data depository, but we have historical data from the onset of every initial mortgage note in America. We will inundate you with trends, topics, podcasts, anything you want to learn about. Now, I mentioned financial literacy. I need your help, okay? I mentioned realtors, I love you, but you're not the experts. Do you agree? You're the experts on the home, but you're not the experts on teaching financial literacy. But my loan officers are, and I need you to partner with them. Here's a buyer. Let's create a home buyer event. Let's create financial literacy. Let's create niche clientele, okay? However, we have an award-winning program at Freddie Mac. It's online. It's in 6 languages. It's called Credit Smart. If you guys are way too busy to teach them financial literacy, at least send them to my program. It's 22 modules of all financial literacy, not just housing. How to read a car note, how to negotiate for an APR, how to shop for an interest rate, every single thing. With that, I conclude my presentation. Rod, hopefully PNC, I didn't go too much. I tend to go on a tangent, especially when I need to support the industry in San Jose. With that, I have to thank you on behalf of myself and Freddie Mac. I know last year was extremely hard, but we are here to help, and we're here because our clients brought us here. With that, thank you so much. I conclude.
You guys get all that? And more. So Nora, I'm gonna ask Nora eventually to not the moment, but like in the future, come again, because that was thing. Yes, Dale. Yeah. Yeah, you'll get a copy of the presentation and this recording. So please go back and listen. I know there was a lot of stats and there are a lot of information. I want to talk about the credit wise, and maybe see if we can get that here for our agents to do that, because I think a lot of people have a misconception about credit when it comes to home buying. So next we've got Hong and Umberto from Housing Trust Silicon Valley. So they're going to come up. Do you guys know about Housing Trust already? But they're going to give you what's going on. I know some of the numbers have changed on how high you can go and the maximum amount for houses, because what was it? We just hit $2 million in Santa Clara County as the medium, which is insane. So welcome Hong and Umberto. No, actually, it's gonna be a and I have with me is education specialist and photo. We're gonna leave a lot of time for Q&A so that what I don't why just we have time for no, in just a second.
Hello guys, how you doing today? Well, my name is Umberto. I'm the first-time homebuyer education specialist with Housing Trust. Before I get started, I want to give it up one more time to Nora. That was amazing data, very entertaining presentation. And to carry off that, I want to go ahead and bring to you guys a couple tools that your homebuyers can use, which is our down payment assistance programs. We have two. One is an in-house program, one is part of Santa Clara County. So with that being said, I'll go ahead and jump right into it.
To have them talk to each other.
If not, I can just. With that being said, let's get into it. Awesome. So a couple housekeeping notes. We are going to have a live Q&A session at the end of the presentation. So if we do have any questions, feel free to write them down. We'll go ahead and try to answer as many of these possible. And if we run out of time, I know we're limited on time. So if we don't have enough time to cover all your questions, we are going to provide you contact details so you can reach out to us, and feel free to ask for business cards. We have Hong's business cards. You have my business cards. Feel free to reach out. Let's link up. And also PNC is here as well. Feel free to partner and network. You will receive a copy at the end of the presentation within 2 days. Jody will be in charge of providing that to all the attendees. So if you're not registered, feel free to reach out to her. She'll make sure that presentation gets to you. Awesome. So Housing Trust currently is on the go. We are working on a hybrid workplace. So that means partial days we're in the office, partial days we work from home. Our office currently is closed to the public. So our main communication would be emails mainly, phone calls. Once again, we'll provide all that information at the end of the presentation. So if you have any questions, you can reach us out. And then we do have collaborative partnerships with lenders, realtors, cities, in order to make sure we get our message out there, which is to help home buyers achieve that home ownership. Great. So how does a down payment assistance help a first-time home buyer? Does anybody want to contribute? No? Shy audience today? Oh, perfect. So we do have 30% down payment assistance, which is correct. But then how does that 30% help a home buyer? So it can help them qualify. If you come with a higher down payment, you have a higher purchasing power. Second, it allows a home buyer to repay. Only for our programs, these are deferred. So this means no monthly payments, no monthly interest. And of course, it reduces the amount of funds that a home buyer has to bring into the close of the transaction, with the benefits of having those comfortable payments that a transaction with a high down payment involves. So the first program that I'm going to introduce to you guys is called Empower Homebuyers. This is directly with Santa Clara County. So how is this program created? It comes from 2016 Measure A that was approved in Santa Clara County on November 2016. There was about $950 million designated not only to this program, but to the county in general to help combat this problem of housing that we have. And works for the first time, for the single family buyers, also for multifamily. So part of those funds are for the Empower program. That is where this program is created. Now, what is this program? It's 30% down payment assistance. It does not have a maximum purchase price, and the maximum loan is 250. So the easiest way to take this in perspective is 30% or $250,000, whichever is lower. So at one point it gets to that point where it caps. I believe the amount is somewhere around like 840 where you can't go. If you do the 30%, it's going to surpass the $250,000. So 250, 30%, whichever is lower. Now, one of the requirements for the program is it is a county program, so home buyers must live or work in Santa Clara County. Then we also have our income limits that are tied into the program. These income limits are still our previous income limits. We did have a change. We are working and updating all those marketing materials. This is what we're currently working on. So the amounts that we have here, they changed about $2,000 on the high end. So just the amounts that you see, $2,000, we'll have the official amounts on our website and post it for you guys. So just stay tuned on that. If you are on our contact list, we will send you an email with those income limits changed. So I do recommend, if we are not on the contact list, that you guys join our contact list. How can we do that? At the end, we have a QR code. You can just scan, easy. All you need to provide is an email. Now, what are the property requirements for Empower? The property must be, once again, it's a county program. The property needs to stay in Santa Clara County. It can only be used for a condo, townhome, single family unit. It needs to be owner occupied or vacant at the time of the purchase. Tenant occupied properties are not allowed. Now, Empower, what does it not qualify for? BMR units, fixer-uppers, mobile homes are some of those categories of homes that do not apply for the program. So keep in mind, once again, condo, townhome, single family. The term of the loan is 30 years. As I was previously mentioned, no payments until the expiration of the term. There is no monthly interest, no monthly payments. Now, when is payment due? At the sale of the property, when you refinance the property, or when you sell the property, of course. Now, when it comes to refinance, you are allowed to do a rate and term refinance, just no refinance that involves pulling money out of the property or any equity line of credit. To keep it simple, only rate and term is allowed for the refinance.
Can I ask you a question? Can you do fourplex?
No, only single family, townhome, and condo. So you must have a first-time home buyer status. So when you talk to your clients, you want to make sure that they are first-time home buyers. They must live or work in Santa Clara County. Minimum credit score, 620, which I believe that shouldn't be a problem based on the previous presentation where we saw all the credit scores. We do have great credit scores in the area, so minimum 620. Borrower contribution, they do have to have a minimum of 3%. They need to bring 3% into that transaction. 1.5 of that 3% can come via a gift fund from a family member. There needs to be a, what do you call it, relative family member, immediate family member. So mom, dad, brother, sister. We require that home buyers also attend an 8-hour education course. That is one of the requirements, but I'm pretty sure you guys are not new to that. Nowadays, all down payment assistance programs require that home buyers get educated first prior to getting these programs as well. Now, we have partnered with 8 agencies. If you go through our website, you are able to see what those agencies are. We only accept, for the moment, we only accept certificates from those agencies. So just make sure when you guys are in those meetings with your home buyers, you let them know these are the agencies that you have to go pursue your certificate. And there'll be a directory there. You can see their website, you can see their phone number, their email, and you can contact them from there. And then owner needs to live in the house, of course. The whole goal of the program is to promote homeownership. So homeowners need to stay in their, the program doesn't allow for you to purchase the home for investment purposes, because that takes away the purpose of the whole program, which is to encourage Santa Clara residents to become homeowners and have a place to live, have a stable home. Now, you guys may be wondering, how are these loans paid? If there is no monthly payment, there is no interest. The way that our loans are paid are through share of appreciation. How many of you are familiar with that term in the room? A few of you guys? Okay, perfect. I have a couple examples that I will go through. To begin with, I have a simple example of share of appreciation. I have home buyer purchased a home 6 years ago, $700,000. They have a share of appreciation loan. Now the home is worth $900,000. So what is the appreciation there? The difference from when you purchased to when you sell. So you have a $200,000 appreciation. Now, if you use 10% of the loan to purchase the home, that gives you $70,000, because remember, you purchased for $700,000, 10%, 70,000 is your loan. In this case, we'll just say housing trust. Now, in those 6 years, 200,000 is the appreciation. So if you borrow 10%, you are required to pay that loan because it is a loan at the end of the day. All loans have to be repaid. You are required to pay the principal, which is 70,000, plus 10% of the appreciation. So 10% of 200,000 under this example, 20,000 for a total payment of 90,000. Now, I'll jump into borrower contribution. Yes. Then you would have to pay at the end of the term. So all the loans are 30-year term. So if you decide to stay there, loan is due at the end of the term. Okay. It would be based off the appraised value. Yes.
Time of the sale, in regards to the amount that it appreciated, do you guys use the gross amount or are expenses contributed to that factor?
So we're doing the borrower contribution, which will allow you to deduct some of those expenses that come into purchasing the home. I'll get into it right here. If you have any questions, we'll get back to you at the end of the meeting. So borrower contribution, you are allowed to deduct your out-of-pocket closing cost at the time that you purchase the home. Now, where can you see this amount? This amount will be reflected in the settlement statement, but it is only eligible if the home buyer paid for it, if you are receiving if the seller's paying for your closing costs, or if you're getting your closing costs via grant, lender gift, realtor gift. These are not eligible for that, only if the home buyer pays for these as well. Then you can also deduct qualifying capital improvements. So the way the county sees this, if you're putting money into your home and you're making this investment to make your home be worth more, then you are paying more appreciation. You are helping for that value to go up. So it does allow for home buyers to deduct those costs. But now here's the thing. It has to be done professionally, and you have to have paperwork to prove for it. You have to reach out to a professional licensed contractor. You need to have a invoice. You can't just have a family member. You can't just do the repairs yourself. You can't have your cousin that works construction just go fix the house, and then that would not be valid. So you have to make sure that you have paperwork to prove for it. So I have another example. Now this is using the Empower loan. This is an example where we put borrower contribution into the equation. It's very similar to the first example that I've explained. Now, in this scenario, the borrower uses 30% of the Empower loan to purchase a $700,000 townhome. Original price, $700,000. How much money did they borrow from Housing Trust? $210,000. This is your Empower loan. So at the time of the sale, 4 years later, the home is worth $900,000. Same as the previous example, we have a $200,000 appreciation. Here it is. Now, from the appreciation, we are going to deduct the borrower contribution that we were talking about, and then we are going to calculate that 30% of the net appreciation. So once you deduct 10,150 from 200,000, then multiply times 0.3 or 30% of that will give you 56,955, which is what is due to at the time of the repayment of the loan. So if we add the principal, which is 210 plus share of appreciation, total due to the county would be 266,955. Now, for the first 10 years, here's where it gets a bit interesting. If you pay the loan prior to 10 years, the program is capped. So what does this mean? This means that in this case, I put right here on the bottom as well. Your home would have to skyrocket in value to take advantage of this. So in this case, what does it mean that it's capped? If you pay prior to the 10 years, the amount of share of appreciation cannot exceed the loan amount. So it is capped. So if your home goes up in this scenario, I would say the home would have to go over 1.4 million. So if the home goes up in value to 1.5 million before 10 years, I do say take advantage of this because your share of appreciation will be capped at what your principal amount is. So this would be your max payment if you pay before the 10 years. But once again, this is only if your home goes up in value crazy amount, which is good for home buyers, but it is possible. So we do have a cap there. We don't know how the market is going to perform in the next 10 years. So it is capped. So I like to just tell people if your home doesn't double in value before 10 years, then just continue with your plans. If your home doubles in value before 10 years, then you may want to consider finding a way to repay your loan. That way you can take advantage of the capped period. Now I will go up to the other side to explain an example of uncapped share of appreciation. Same exact example, purchase 700,000, home is now worth, no, this one's different actually, 700,000. Now 25 years later, the townhome value is 1.6. So the principal amount of your Empower loan is still the same. We're still at 210,000. Now the appreciation is 900,000. How do we get 900,000? 1.6 million minus the purchase price, which is 700,000. Now we do have our borrower contribution. We are going to also multiply that by 30%. Here is our share of appreciation due. Now, what is the total amount due to the county? 476,955. So here's the other scenario where you might want to consider if your home goes up in value to 1.6 in this example, you may be better off. You will be better off if you pay it off before the 10 years because on the previous slide, I'll go back and show you. This will be the max payment in the case that your home goes up to 1.6 for 420,000. And then something I also like to tell realtors, lenders, I know that when we show these examples, 476,000, it shows like it is a lot of money. On the previous example that we did, we'll show the amounts of 266. It seems like it is a lot of money, but 210 are already in the property. So that money, they already have it by the time of the sale. So I recommend telling people don't get intimidated by this amount. The only amount that's coming out of their pocket is the 56,000, yes. Now, jumping into the good stuff, how do they apply? How do home buyers apply? Where can they get the process started? So the very first step in the process is to fill out an online interest form. This one is available at our website, housingtrustsiliconvalley.org. It is, you click under the, what do we do? Homeownership assistance, Empower. If not, you can always email me. I'll send you the link. If you don't want to navigate through our website, we can do that as well. So first step, you complete an online interest form. Your home buyer does. Now, what is this good for? It gives us a better perspective on the home buyer to see where he's at on his finances. If he has the amount for his down payment, it's good for pre-screening. If they fit the criteria, we send them to do the home buyer education that we were mentioning. If not, we will get back to them and give them some tips on what needs to be worked towards getting to the home ownership. I'm pretty sure as realtors, you guys know that sometimes, most of the time, home buyers are not ready to purchase a home, but they need to start planning. So if they're not ready right now, it doesn't mean they cannot come back. So if it doesn't work right now, they're more than welcome to come back, but we let them know what they need to work towards when it comes to returning so they can be more prepared. So if they are prepared, we would go ahead and send them to do the home buyer education. They give us a certificate. Now, after that, we will send them to get a pre-approval from a participating lender. Our friends at PNC Bank over there, they are approved for the program now. So they are able to go ahead and roll out the program as well. So they would get a pre-approval from, in this case, PNC Bank, sent back to us. Once that gets approved, we will schedule a 30-minute pre-purchase review, which is step number 4. They will meet with housing trust staff, and we will go ahead and do a 30-minute pre-purchase review to get to know the home buyer better, explain to them more than anything, clarify if they have any questions on the program, if everything's clear so far, and we explain to them how to submit the application. Now, previous to step 5, the home buyer does not have submitted an application yet. So I know sometimes home buyers get confused and they might reach out to realtors. Hey, I'm ready to shop. I already submitted the application from Housing Trust. We're ready to go. The best thing I would recommend for you guys, ask for a pre-approval. If they don't have a pre-approval from Housing Trust, they are not fully approved yet. So once the pre-purchase review, they go ahead, they submit the application. Review takes about 30 days. Once they have the application, they get the pre-approval from Housing Trust. And then now they would be good to shop for a home. I see someone raising their hand back there. Oh yeah, no problem.
I needed to find out, do you have links for this?
We do. We have links for everything. We will be providing, if you guys reach out to us, we can provide you with our guidelines. We can provide you with our policies and procedures. We'll share these infographics with you. We can give you the links for the home buyers to complete the interest form, anything that you guys may need, okay? We'll provide you with the tools. And then I also have some flyers for you. So if you guys want to take 1 or 2 just to keep, we can go ahead and give you this. Now that covers Empower. Now I will go ahead and jump into the in-house program that we have at Housing Trust, which is the HELP program or the Home Buyer Empowerment Loan Program. What does this program do? 10% down payment assistance. This one does have a maximum purchase price. $800,000 is the maximum purchase price. Same concept, share of appreciation, 30-year deferred loan. The property must be located in Santa Clara County, of course, but it also, compared to Empower, this program has the cities of Menlo Park and East Palo Alto in addition as well. And what is different, this program is built for people that have slightly higher income limits than the Empower program. So you might have clients that don't qualify, that they make more money than what is required, that the maximum for the Empower program. So this is where HELP jumps in. You may have a client, if they don't qualify, you can let them know, hey, Empower may not work for you, but here's HELP. We have higher income limits. These also changed as well. Just a reminder, we will email these via our contact list once we with the correct amount once everything's updated so you guys can go ahead and take a look at those. So make sure you join the contact list as well. Now, it can only be used for condos, single family, townhome as well. It cannot be used for BMRs, mobile homes, fixer-uppers as well. And it is also paid through share of appreciation. This example is exactly the previous example, the first one that we showed on simple share of appreciation. This program does not have borrower contributions or qualifying capital deductions. So it is a simple share of appreciation, just like as a previous slide. So this is how the repayment would look like. Program differences. What are the program differences? Of course, the down payment assistance amount, 30% versus 10%. The maximum income is 120 area median income for Empower, 140 for HELP. They are both through share of appreciation. Deduction, as I was mentioning, is that allowed? Yes for Empower, no for HELP. And HELP is also not capped and uncapped for 10 years, prior and after 10 years. Awesome. So I do have our contact information right over here. If you guys want to take a quick snapshot of it. Here we have our website. We have our webpage for both programs, Empower and HELP. We also have our email where you can contact us. We have a phone. And if you want to join the contact list, we have the QR code right here as well. We have the link where you can click over here. So if you have any questions, feel free to reach out to us. I'll give you a couple minutes. We'll jump right into the Q&A right now.
Quick question. Not being a West Coaster, just a point of clarification. Is this more like a loan for down payment assistance as opposed to a grant?
It is not a grant. Yes, it is a loan.
That's the second part. Will the properties become deed restricted? Meaning that there's caps on who could buy them. And is there a lien placed on the property, say if in fact, and this is again, the difference between East Coast and West Coast, even in the Midwest, we have deed restricted properties keeping the border. And so my question is, if one was to utilize the Empower program, will that property be restricted beyond those income components that are within what you've explained already? Nobody can confuse the crap out of you.
No, that's why I have a hung.
My staff to answer, but so great questions. is a deed restriction. So for this particular program, because I know like for CD program, they do tend to put these restrictions to, just maintain that eligibility and maintain that affordability housing, right? But for this particular program, the county would allow, no deed restriction. The only thing that home buyer need to prove and show during the purchase, all the way till they get the key, is maintain that eligibility to be within those income limit, post access restriction. These are things that during the purchase, once you get the key, once it's done, is there income recertification? No, none of that. The only thing that Roberto mentioned earlier was staying in the property as your primary resident. That's the only thing the county wanted to make sure that you're staying there for the life of that program loan. If you pay it off, do whatever you want with it too.
Right.
Great.
So moving on to the next slide, we do have a couple of QR codes that you can scan to go ahead and get more information on our program. Also, we would like to invite you guys, lenders, realtors. We are having a couple of events next week. We are having one in Gilroy. This will take place at the Council City Chamber. This event is going to be in Spanish. We have one the following day in Morgan Hill on the 30th on Morgan Hill Council City Chamber as well. This is in English. It's open door event, but we would like for you guys to, if you guys have like any clients and you want them to get more information, you guys can just go ahead and take them over. Realtors, feel free to join us. You can go ahead and take your clients, then they can get educated, learn more about the program. And that way you guys can go ahead and motivate them more to go ahead and try to pursue the program, okay?
Make sure everything's okay.
Similar to that, yes. Okay, with that being said, we can open the room for Q&A. Yeah.
Is this different from the California?
It is, yes. It's an entire different program. No, this is a first come, first serve basis. Yes. Yes.
For household size, is that defined by applicants plus within self-taxing?
So your household size will be qualified as everyone living under the same roof. Now, for dependents, do we also include those on the household? Only if they're living with you 50% of the time, correct?
Definitely as where they come to us, it's a collaboration effort, right? With the senior lenders, loan officer, with realtor, with us, we're all here to help on that home buyer. So everybody would depend on that home buyer's process, because it's definitely a little bit more challenging when you have to deal with two different lending guidelines versus just one and make it simple. So definitely we can help our home buyer to make sure they understand our process. It's definitely completely different than the lending traditional one. Right? So therefore, yes, we're absolutely. Yeah. And then to your question about households eligibility, like household size. So it is a little bit different than, and it is even very different from down payment assistance program from different agencies. It's all about the definition and the requirement. So it's always something I tell home buyers. If one door closes, doesn't mean it all closed, because you assume that everybody offered down payment assistance have the same guidelines. No, it's not. You'll be surprised. Maybe California HFA with their California Dream have different definition about, and they may have different, exception. That's different than us. So just don't think that, it is a little bit challenging, because that's a lot of homework the first home buyer needs to navigate, right? So for your questions on household, we're looking at the current, as you apply, what is your household? And it can be by blood related or not. Just simply two people live together, not by blood. But if they're applying, you want to see the entire household to make sure they qualify. Regardless where the intention later on, are they moving in together or not? But at the time of application, we'll look at the entire household income, assets, all the tax returns, all these to make sure they are eligible for the program. Through the purchase, when the key done, if you get lottery, if you win money, and you still want to stay here, you don't want to pay off the county, that's not such a it's your choice. We're not here knock on the door, say, hey, you got to win lottery, you should pay us off. I mean, you should, because that money will still go around and give it to our first time home buyer. But that doesn't mean that, no, we're gonna go onto your door and say, time for you, just because of that.
And we'll do one last question, because I know we're a bit tight on time, right? So we'll do one more. And then if you guys have any questions, you guys have our email, go ahead and shoot us an email. We'll go ahead and reply.
This might be a little.
We'll get you to, sorry.
This might be a little deep into the woods, but and it probably needs to be answered by both PNC and you. How do you guys handle amended tax returns?
So this is good. Amended tax return, we definitely dive down to it. We will ask for the original, the amended, and the explanations. Yeah. But the thing is that the way how we look at income, we don't look at the past 2 years to average. The way to look at it is, what are you earning right now? What the next 12 months look like for you? And that's what we do. We qualify this entire family within that income zone. It's not about the past. It's about what are you doing right now and what is the next 12 months look like for you. That's what we do. So our income always a little bit higher just because we're looking at the future. But we're as a lender, we're helping the county. That's the county guideline. But as a lender, we also want to make sure that is it substantial? We can't just simply somebody just like, hey, I just got a job. Let's do this. I'm like, are you or been working? So we do a mixed combination, but we're not really deciding on the past historical.
And I'll get one last one on this lady. I know you were raising your hand. I know you were raising your hand for a long time, so I just want to get sure. No, let's go ahead.
Just the Measure A funds, where do they actually come from? And how do they get replenished every property taxes?
If you notice in your tax,
yeah, it is. I'm not San Jose, but
because it's on mine. I do always see it.
And so do you? I mean, I know like how half of they run out of funds. I have someone in it now. We're waiting for a voucher, but for you guys, if I were to put somebody in, like how, if they qualify, or do the funds ever run out? Do you just move from program to program?
How do I say it? Yes, fund can be, it is limited, right? But it's still available. And the way we do it is not like, you know, if you have someone ready to go, then ready to go and get them purchased ASAP. Just like what Nora was saying. You buy now, you don't wait. If you make all that effort to do all these paperwork and give it to it, it's like climb a mountain. Do you want to wait and sit? No. It is the time to buy, and because it's first come, first serve, funds available, why don't you come get it, buy it? That's what it should be. There's no lottery period. There's a time for you to go and buy and shop. No, it's all your and your home buyer action, immediate action. Because when you do, you have that time frame. You want to be within your eligibility. Do you want to stay for a year and like, I'm not going to get a job so that I can stay within that income frame? I don't think you want to. So right. That's what I always tell my home buyers. You go through a lot of hoops. You gotta make fast.
Does the buyer need to get a certification of training or education?
Actually, it's pretty much like a person was saying, right? It's pretty much refined from all other programs. Just make sure that they are one of our 8 approved agency, and there's across the Bay Area. There's A1, some of the very one up north too. Target Sentinel, so it can like put one for other programs, like if they're not qualified first, you can use for other one. But yes, they do need to get that certificate completion, and it's only for borrow and non-borrowing sell. What I'm talking about, husband and wife, don't have a stuff yet. You just need to take the class, get their individual certificate. That's the first thing, because that really tells us, am I ready? Am I not ready? Do I even want to do this? It's a commitment. For you to, if they commit it that way, you're have a really committed home buyer to be, you know, making that.
Is there expiration for the approval? It's approval. So expiration.
Expiration for the certificate or for house pre-approval?
Your fund.
For house pre-approval, it's usually up to 90 days. Why do I say up to 90 days? Because you know, it depends on the document that they read for, the lender pre-approval. But you know, sometimes will tell me whole map to get, they know what to do. They have everything in PDF, and that's here, reapply, just upload. They're already known.
So we're going to cut it off right there. We're on a limited time. If you guys have any questions, feel free to send us an email. I'm gonna go ahead and pass it back to Jody. But thank you so much for your time. Thank you for listening. We'll continue with PNC Bank.
And this is literally, I hope you guys understand, coming for full circle of like everything that you're getting today is literally go to your client and say, here's how we do this together. You have a program, you have a lending partner, and you had incredible information from Freddie Mac. Where am I? You said Freddie Mae or Fannie Mae earlier, and now I'm like Freddie Mae and Fannie somebody. And so this is literally, it really is coming full circle. So I'm going to introduce Amanda with PNC Bank. And then I have a couple things that I do want to wrap up with just towards the end, and then we'll send you on your way to go find those first-time home buyers.
All right, so I'm one of the last speakers, and I will try and talk as fast as Nora does, okay? So I need the clicker to go quick. All right, so
PNC, right?
I am PNC. I do work for PNC, and oh, where'd my slide? Do I have slides? No problem. So we put this together, and we're kind of wrapping it all into one, right? We wanted to tell you about the market, tell you what was going on in the affordable space, and show you that there's so much more opportunity that we can get to. Then we wanted to tell you not only do we have some good programs, but we also have a down payment assistance program here in the county that can help us get more borrowers into their homes. So I am going to wrap it up with some of those programs and also just tell you a little bit about PNC. So I'm going to tell you about PNC, and then my counterpart Rod's going to give you some of the programs that we have specific for this. Now to talk fast, I'm going to let you know I work for a bank, and here's proof. Maybe not. What am I pushing wrong? There you go. Small disclosure. That's how you know I work for a bank. Fine print. Nothing I say is my personal opinion. What am I doing wrong? Okay. I can talk fast. I can't click fast. Now, the next slide I'll let you know is a little bit about me. When Nora brought up that we have a population that's, when it comes to, see, look, click, click, backwards, backwards. When it comes to the loan officer population, one of my passions is to bring new people into our business. At PNC, we are not large, but we are mighty. We have some very, very experienced loan officers. And one thing that we do at our company is we help pass on the information. So we do have a newer generation coming into the lending business. And one thing we do before we put them out in the field is we train them very well through a mentoring program. All of our seasoned loan officers, many of which who are in this room, have personally helped some of our newer loan officers with their packaging and helping the ability to get more borrowers into their home. So when you do a loan with PNC, you do notice a difference. You'll have a lot more tighter qualification, a lot more pre-underwriting before we even send it to the underwriter. And that's just about me as one of my passions. Now, there is a video that it just won't go to. So what we'll do is we'll skip over the video just for time's sake. We can see, oh, now it's playing. So that's a little bit about PNC. Just to let you know, we are, and summarize it, we are coast to coast. We are in all of the 35 major markets within the states, as well as some of the hottest housing markets available. We also, oh my gosh, am I pushing the wrong button? Next one. I can tell you how great we are, but all these people already told us how great we are. We have a lot of awards, especially when it comes to our mortgages. It's not something that just us, I talk about, but it's something that the industry talks about. I can't.
I think you're pushing the back button.
Oh, the forward one's worn off. That makes sense. Not.
Count up next page, Amanda.
All right. Gee, I wasn't part of that generation. we have at PNC, we have an initiative called Grow Up Great, where we like to not only bring in the next generation, but it's specifically targeted at the early ages up to 5 years old. And so we lend out, we actually don't lend out, we give out thousands of dollars, millions of dollars every year to charities and programs that help young members of our society grow up. Because it's a passion. If we start young, then hopefully it'll bleed up. Look at that, I went forward. So 88 billion is our pledge in lending. Megan already talked about this, so we'll skip it. But here's some really nice listing resources for you. So when you do go into a property, not a lot of people realize this. This says 75,000, but we do go all the way up to 1%, and particularly a $10,000 grant available to borrowers to help get them in the program or get them into the house. That's something we can do on a yard sign for you, as well as we have flyers specific around this program. And for your open houses, we can do it, print it specific to your house, to that offering, especially if it qualifies for the grant. So you can put that in when you're talking to buyers and potential customers of different things they can use. Borrower tools. One of the best tools we have is our technology. We have the seasoned loan officer, which we really prefer that the customer talk to the seasoned loan officer for the very reason I told you earlier, that they can package it so that it can go to underwriting and pre-underwrite it quickly. So that way they can see problems up front, not when you're in the middle of the transaction getting ready to close, because no one likes a rushed closing. And so what we do is we meet with the loan officer first. They pre-underwrite, pre-package the file, send it in, and then the borrower can follow along online of what's going on with their file. So nobody's left in the dark. If you've got a borrower who's saying, what's going on with this? Why am I not approved? What's this underwriting condition? More than likely, my loan officer's already told you this is going to come up. We need to be prepared. So when the underwriter comes back, we're prepared, and they will be able to see all of that going on online. And then next, see, I talked fast as I could. Oh, next I have my counterpart, Rod, who helps us quite a bit, especially in this space. And he's a major reason for today's event.
No, you told me what to do. So let's call a spade a spade. Again, I'm Rod Hirsch, and I don't want to do what you did. So, and I support the territory from Ohio all the way to the Pacific Ocean. So, and what's amazing is that the housing prices, right? You know, and I'm like at awe because like 250,000, I could buy 3 houses in Ohio, right? You come out here and $250,000 just not even the 20% down. So it's really amazing to me. So having said that, I want to share some of the tools and the resources that we have available for borrowers. As we one of the benefits of PNC is that we deliver to all 3 agencies. We deliver to Freddie, the redhead, people down the street, Fannie. We are a GS, we deliver to HUD or Ginnie Mae, and we have a portfolio. So we have 4 different avenues. So I can truly say if a borrower is mortgageable, we have an avenue to park them. I don't have my glasses and I cannot see that. Oh my goodness.
Well, I know how that is.
Oh my goodness. Oh, okay. Some of our special, speaking about the portfolio, yeah, you're right. But my mind keeps saying I'm a millennial, but my body says I'm a Gen X. So we have a portfolio product as well. It's called the PNC Community. That's a product that we listen to the needs of the community, right? And the needs were, what are the obstacles of getting into a home? Down payment and FICO score. So what we did was we reduced our FICO. We came from a 700 all the way down to a 640. And the down payment, we allow the down payment to come from just about anywhere as long as we can verify it. It can come from the seller. It can come from an interested third party. It can come from Empower, and we'll recognize that. And all we need is the borrower to have $500 of their own money. We also participate with USDA. for those rural housing, as Nora alluded to. Now, I think this says specialized loans. Okay, great. Now, this is huge because we participate again with both GSEs and we have a variance. What that variance means is PNC has a special relationship with them, and they are allowing us to not require a minimum investment from a borrower. So having said that, we can use our resources here for down payment. And Freddie and Fannie will recognize that without having the borrower have any money into the transaction. Some of our sources that we have, it's a $2,500 low income grant. Well, what that is, if a borrower's income is 50% of median income, we'll give them $2,500. And mind you, all of these monies that I'm talking about is a straight up lender contribution. Last year, we gave 10 million. The year before, we gave 10 million. And I can say that we've always given the same dollar amount. We're not shrinking. But what we are doing is expanding, but we're not shrinking our giving. And the second thing I can say is that we don't give a 1099 and we don't take second lien position. This is a straight up lender cost of doing business. And we have several grants, and I'm just gonna stab the next one is 7,500 or 5,000. Well, depending on the area, we'll give you a grant for $7,500. We also have a $10,000 grant, which is our version of our special purpose financing. Well, I can say that California is eligible for the special purpose financing in conjunction with a 1-point rate buy down. So basically, if you have a assessed market that we're providing special purpose financing in, we will give you $10,000, and then we'll give you another lender credit of 1% of your loan amount. So let's just say you got a $800,000 loan and you're trying, well, you got to keep it conforming, 766, right? So if you got a 766 loan, that's $7,600 plus my $10,000, that's $17,000 that we were giving you. And you got experts like Max in the back who's taking that and he's, instead of using it for down payment, because down payment is not an issue here. Rate is more an issue here in California. So we want a low rate, right? So what Max is doing, Max is taking that $17,000 and that equates in some cases 2 points, and he's buying that rate down below competitors, because now what happens now, you got a rate that if another lender wants that business, they got to buy it back from us that we're already giving it. So contact Max. Max, give me your hand. Shout out. And there's some another thing I want to say. One of the things I'm so proud about the PNC is some of our core values. One of the main thing and core values that I like to point out is teamwork. Teamwork is a cornerstone of how we get down. Now, everybody that's here are a part of our team. And thank you. And these guys came out to support our efforts and our cause. So thank you guys for coming out and supporting our mission and what we do.